What the hell's going on, YouTubers? I want to talk to you guys today about the market and where I think it is going, and how in the next couple months or years to come, there are signs that are pointing that the market may drastically change for the worse. Um, by no means, I want to disclaim, by no means am I an economist or predicting that the market will crash, but what I am looking at and going to show you guys today is what I am seeing in terms of the economics and the fundamentals behind the stock market and what is kind of done in the past, and really just overlooking or giving you guys an overview on why it has been going up, what sectors of the market have been really staying steady, and maybe what some of the sectors have been going downhill. Um, but overall, as everyone's kind of aware, market's been on the up and up. If you look at this price to earnings ratio, which I'll get to that in a second, this is kind of just going up in general. And actually, let me just show you guys a quick um, view of the S&P 500 over the past 10 years or so. As everyone's familiar, in 2007, 2008, we had the financial crisis, which caused several people to lose 40, 50, 60% of their portfolios. And ever since then, we've really been on a tear with respect to prices in the market. We had a little squibble in 2015, where essentially everything started going back towards the 200-week average, which is this green line here. And ever since we got close to that point, we've really started continuing up this trend. So peak to trough, you're looking at just under 800, 700 something here. Actually got down to the 600s at one point, and we are now up to 2400. So that's just the S&P 500. If you looked at the Dow, if you looked at NASDAQ, it would do something pretty similar. But what does that mean? I mean, like, this is just a number on a screen, right? This is just 2400. But what are the fundamentals telling us? So that's really what I want to get into, is the Shiller PE here, which is really a measurement of your price for what the earnings are. And so fundamentally, every share of a company has a set amount of earnings that are associated with the company. So essentially, if a company, or let's say the S&P 500, makes $100 per share of earnings, a fair value might be, like, let's look something here. A fair value might be 15 times $100. So that would put the S&P 500 at a price of $1,500. In retrospect, we're producing at about 95-ish dollars of earnings per share of the S&P 500, which puts us at a price to earnings ratio of about 29. So to put it in perspective, a lot of people say value stocks are anywhere between 15 times earnings and below, whereas growth stocks are 20 to 25 times and above. So that might be your Visas, your MasterCards, your Amazons for sure, Google, and more recently, Apple in the past was a growth stock, but now, since it's such a large stock, it is actually more of a value stock, which trades just below, I think, 15 times earnings. But basically what this is showing you is, over time you have parts of the market which will be bearish and then sometimes really bullish. So obviously it's more expensive the higher up number you're getting. So for instance, Black Tuesday, for every dollar of earnings that a company was making, somebody was paying essentially $30 equivalent to purchase that company. Immediately thereafter, it dipped down all the way to 5, as everyone remembers, after Black Tuesday, and the market had a big crash. Great Depression started, and basically the market was just kind of hanging out until the mid 40s. It doesn't really show it in this price, or the PE ratio, but the market took quite some time to get back to the point where it was in 1929. And then you get to the point where in the 80s, things were just kind of chilled out. PE ratio was around 10. And then more recently, we've gone the other way, where obviously in the dot-com boom, you had all the internet stocks and the growth of all these internet stocks kind of coming over and taking over the market. So you had the WorldCom booms and all those like internet companies really taking over the market, and essentially that's why your price to earnings ratio is so high. People were paying for internet companies that didn't necessarily have a lot. And then 2008, we were at about 25, 26, 27 times earnings. And then once we had the actual financial crisis, earnings dipped down to 15 times, and we've really been on a run up ever since. So what does that really mean? I mean, the important thing is, it's like, yes, this is a number that you can kind of fall back to, but what does it mean? Well, it's like, okay, well, let's just take a quick look in the actual ratio itself. So anytime you're getting above 20, it eventually gets to a point where it starts correcting, right? And so how does this actually correlate to our earnings? Well, so let's just take a quick look back again at our S&P 500, right? So since 2009, we've been on this huge tear, right? So since 2009, let's just do a quick look here. We're up about 150, 200% if you were to get the exact trough down below. 251% if you were to get the exact trough down below. So there's that aspect of it. But what does that really mean? So in the very bottom, December 2008, earnings per share for the S&P 500 was about $17, right? But okay, so the next year was 57. Okay, so a little bit better. And then $86 in 2010. Okay, so that's, what is that? 5-6 times, more. 2011, 93. 2012, 91. And it really flattens out. I mean, yes, 93, 91, 104. Remember in 2013 we had like 30% returns, but it's really just kind of hung out since 2013, and it hasn't really grown. I mean, if anything, earnings contracted in 2015, and as you remember, with the contractions, the market was kind of really volatile here for a while, and it kind of just was hanging around. And then in 2016, it slowly, sorry about that. In 2016, it started picking up a tad, but it's really remained flat or even less than what it was in 2013. So why is the market continuing to go up if earnings and profits from the S&P 500 are flat? Can't really say. I mean, there's a lot of different things that can really predict that. Maybe you guys can comment down below in the comment section as to why you think it is. But if earnings have really peaked out in 2013, how can the price be continuing to go up? It's the Shiller PE ratio, where essentially you were producing around this time, this is 2013 time frame, a PE ratio of, let's say, 20, and you're essentially 50% more than that at this point. And that's really what it is, right? So in 2013, your earnings were, or your price was essentially, 1700. Well, boom, you're double that now. You're $800 more than that now per share. So where are these really coming from, right? I mean, where are these gains actually really coming from? Because if you look at companies like Phillips 66, it's like, okay, since 2012, I mean, this is a good example. I mean, this thing was on a roar when it IPO'd, right? 164%. GE is only up in the past like 4 or 5 years, like 48%. The Vanguard REIT index in the past 5 years is only up 25%, right? I mean, in 2013, like if you were to just do 2013, I mean, what really happens? It's 18%. Where's that 50% return coming from? NASDAQ 100, though, if this is something that you're looking at, I mean, just in the past year, it's returned 30%. Where in 2016, I think we produced, let's just double check, I think it was like 16%. Yeah, just in the past year, we produced 16%. But if you look at the NASDAQ itself, it's produced 31%. What am I trying to show you here? I'm trying to show you that the majority of stocks aren't doing that well. But what's happening is we're really overpaying for a select few stocks, which is really driving up the Shiller PE ratio. A lot of stocks and earnings have remained flat for a lot of companies, but we're getting, I guess, saturated. A lot of outside money potentially from other countries is coming in and really expanding our PE ratio for the entire market. Now, I'm not saying that the market's going to collapse tomorrow, or I'm not going to say that earnings are never going to go back up again. I don't know those things. If I did, I wouldn't be on YouTube making this video. I'd probably keep it quiet. But what I am showing you is, the fundamentals are talking to us, and I think we really need to pay attention to it. I don't know what a lot of this stuff means, but if you look at this, it's like, well, this is getting pretty high. Like, there's really only been a couple other times where this has been a lot higher, and one of them was Black Tuesday. One of them was the dot-com burst, right? So it's like, how comfortable do I feel having my money in here? I don't know. Like, I love the market, and I'm trying to make like a passive income off of dividends. But at the end of the day, it's like, this is pretty frightening with respect to, having my money in the markets and being vulnerable to potentially another downturn. But luckily for me, I mean, I'm only 25, and so, I have a long time. Like, even if it came back down to 5, like the Shiller PE goes up, it goes down. So as long as the earnings don't drastically decline, and it's just the PE ratio that really corrects, then over time I'll be fine. But in the meantime, it's kind of disheartening. It's kind of like, should you take money off the table? And so I'd really like to hear your comments down below. I didn't mean this to be clickbait or anything like that, but I really just wanted to hear the opinions of the other people on YouTube, and really hear what you guys are doing to maybe minimize your risk associated with this high price to earnings ratio, or what you're doing to maybe make up for some of this money that could be lost. Are you being more conservative, getting less volatile stocks? I'd really like to hear from you guys, and I appreciate any comments that you guys might have. If I misspoke on anything, please correct me in the comment section down below. But otherwise, love to hear from you guys and learn, as I am pretty young and I've only been doing this a couple years at this point. So, all right, I'll talk to you guys soon. Have a good night.